Hi, everybody. Welcome to the Lowdown. And joining me today is Chris Roberts. Chris, welcome to the show. Well, I think we got a lot to cover, and I thought we'd just start out. The last Lowdown we did, kind of a uniquely titled, but it was the ever-changing narrative. And I thought that was a good title for kicking off the year. And reason being, 2022, towards the end of the year, some of the most bearish sentiment that we've seen. But I thought maybe you and I could just kind of cover a little bit, what happened in January and back to, the name of the Lowdown, the ever-changing narrative, how that transition happened into February, much different. And of course now where we are, and we're going to talk about where we're heading.
Well, it seems like 2023 kind of picked off where 2022 left off in terms of, lack of clarity and volatility and everything in between. So I think first you just cover, why did markets rise so much in January? I keep getting that question, and it's really comes back to fundamentals for once, right? We had a lower than expected inflation reading for December that came out in January. That gave a lot, I like to use the word hopium, for stocks, where they rally on the prospects of a softer landing, where the economy doesn't go into a recession and the Federal Reserve can, reduce interest rates and become more accommodative. Then of course we saw an acceleration in China's reopening too. That kind of faded into the back of our mind, but they basically went from no COVID to we don't care about COVID, which that's the global manufacturing engine, so that really helps. But then also the winter in Europe, right? We talked about the coming energy crisis for Europe as the winter came along, and now they're in a winter that's 3 standard deviations warmer than average, right? So that really helped alleviate some of that, natural gas, pipe pressures and the Russo-Ukrainian conflict.
Even globally.
Exactly. I mean, we've seen natural gas prices absolutely just plummet off of their highs from last year. Some of that's due to the warm winter. Some of that's also due to turning the taps up when the price is, $8. But then also there's technical reasons. January effect is always there, right? There's always money to be put to work in January, start of the year. That naturally happens every year. But then just general bearish sentiment, right? We kind of talked about it at the end of last year too. Sentiment was so poor that any sort of a catalyst, i.e., a better than expected inflation reading, was going to create, some gusto for portfolios and for markets. And then of course, February flipped everything on its head again, again, it just keeping with the ever-changing narrative and what have you. But, there's a number of reasons why, February was a pretty brutal month for most asset classes, just like January was pretty positive. We've seen a lot of earnings revisions, right? We talked about that at the end of last year, that was the next shoe to drop. And then January, most earnings results that were coming out of around Q4 were fairly positive, and even the guidance was pretty positive. Well, throughout February, companies continued to report. I'm thinking of Walmart, Home Depot saying, hey, Q4 was great, but these next few quarters, we're starting to feel the pressure of inflation. We're starting to feel the pressure. And that, of course, is that guidance that helps bring those indexes down. It helps price in the economic realities that weren't priced in a couple months ago. But then we've also got a lot of leading economic indicators that are still quite negative, severely inverted yield curve. The worst, I think, I've seen in my career, and probably close for yours. But then also a contractionary purchasing managers index as well. We're in that PMI for short. That's usually what you hear it said on CNBC. Very contractionary, well below 50. Negative money supply growth, so that's just the Fed ripping liquidity out of markets. And to that point, they've said, the Fed throughout February has said, hey, we're, while we're getting close to a pause, the hope for significant cuts throughout February by the end of 2023. That was the original narrative, that by the end of 2023, rates would begin to decline. That's what the market was pricing in. That expectation was overblown. And so that has to be priced in. But then also the Fed has really ramped up their quantitative tightening too. It's not just about interest rates. It's about, buying and selling bonds. And so they are, ultimately tightening at a pace of $95 billion a month, which is definitely not unnoticeable. So
absolutely. Well, and so that kind of gets us now. I mean, here we are, kind of kicking off, March. And, I think one of the other things is just, and you and I have talked offline about this, but just kind of looking at, where is the consumer, looking at the things like the CPI number. And I think you've got a chart on this, but maybe kind of walk us through this chart on CPI. I mean, people don't understand the components. What makes that up?
Well, that was the catalyst, right? We talked a lot about why, things were overblown at the end of January, all those negative or leading economic indicators that were pointing downward, so to speak. But then also the real catalyst last month was the hot inflation print that came out for the month of January. Now, there's a number of reasons for that hot inflation print. Some of it is seasonal and how there's different adjustments made to the calculation. But then, like you said, let's break it down, and we'll throw the chart up here for just a second. But, looking at CPI, focusing on the far right hand bars, if you will, you'll notice that the yellow, the shelter inflation, is incredibly sticky right now. Right, that was the main driver behind the surprise in the inflation numbers we got last month. Was that shelter inflation did not fade, and that of course caused us to exceed expectations in a negative way, not a positive way. And so all that kind of comes back to the relationship between rents and valuations, right? Rents lag behind valuations. Valuations went up through the pandemic. Rents lagged behind that. Rents are catching up. And now we'll see the other tail end of that over the coming couple of years, which is now valuations come down, rents come down, but then also tons of supply comes online too. I mean, you can drive all around Houston and see just how much multifamily supply there is coming online as fast as possible.
Take a drive through Texas, and you're seeing expansion now. We're in a migratory state, so that's a little bit different. Texas, I think, has a good ability to weather the storm more so. And then just to, kind of talking about that shelter component, that's a huge percentage of CPI. It's about 30% of CPI, so that does matter in one of the biggest laggards.
And you can see it increasing over time. This is from April 2021 to January 2023. The yellow portion of the bar over in April of 2021 was not that large. It was all in the energy and the core, in the goods and what have you. And you've seen how the inflation narrative, talking about changing narratives, has changed, so much. And in fact, we're seeing core goods disinflation for January still. Core services, not that bad, if you look at it on a month-over-month basis. So really a lot of what was in that bad report in February was in shelter, and we do think a lot of that, will fade as valuations fade as well.
So here's kind of a story, just things that I'm hearing. People are talking about it. You hear about inflation, you hear about rising costs, right? So I think anyone that's walked into a restaurant in the last 2 weeks, you look around, you're like, okay, wait a second. Everyone's still here. Everyone's still eating out. I mean, you go to anywhere like a rodeo, anywhere, people are still spending money.
Oh my God.
You go to the malls, they're still there. So obviously, I mean, it seems like the consumer's really not paying attention to this. But I think there's the one thing that people are missing, and I think you've got a chart here, Chris. But let's talk a little bit why. And I think my quote would be is the consumer's borrowing to maintain their old lifestyle.
Yeah, and and like you said, we'll throw the chart up. This is really the most telling thing about why the consumer is remaining strong despite the inflationary pressure. And like you said, they're financing their lifestyle. Look at the dispersion, between household savings rates and credit card debt. We call it consumer loans at the Fred, but it's basically credit cards and other revolving plans, right? So just floating debt and things like that. So, I think what we'll see here is that as that debt becomes more restrictive, as rates move higher, eventually that could cause the consumer to more or less collapse, right? Because eventually we're going to reach a breaking point where savings are depleted, the interest rate you're paying on that credit card debt has effectively doubled due to the Fed increasing rates. And so you could see a significant decline in all of this bullish consumer momentum that we've seen, throughout this inflationary period. And then of course that lends way to potential over tightening and what have you. But I think you wanted to
no, it's just interesting, this chart. I mean, you look at where it really broke, right there at the all the QE programs right there in 2009, 2010, it came in as a result of the great financial crisis. And then you see that blue line spike. You might be asking yourself, well, where did all that personal savings? Well, that was the CARES Act in the pandemic. That was the government's, basically
and people didn't have anything to spend money on either. You couldn't get a car. You ate at home. You didn't travel.
Well, and so this kind of leads me to, and I got some pretty interesting stats because, as I just mentioned the story, you just don't see visually where the consumer is breaking down. But I think as we pointed out in this chart, they're clearly borrowing. Well, let's talk a little bit about some of the actual stats. Right now, record 36% of U.S. adults have more credit card debt than savings. Okay, this is up from 27% in 2022, 21% in 2021. Credit card debt jumped $130 billion in 2022, the biggest increase in history, now to $986 billion. So basically, we're fighting inflation with credit card debt, right? Yeah. And then if you look at just interest rates, now credit card debt at 24%, mortgages now at 7.1, right? So I mean, it is a much different environment than where we were in before.
Yeah, exactly,
right?
Exactly. It's awe-striking how quickly it's happened and how quickly that dispersion has widened. Like I said, it can just as quickly contract. Now, to that point, there was a lot of commentary that came out this week from the Fed, and even today, as we're recording this episode on March 1st, a lot of commentary that came out. And I think you had some points on that regarding why the Fed would likely or will aim to keep rates higher for longer, despite the fact that the consumer could fade quickly, shelter inflation could roll over quickly. Ultimately, they've pointed out some reasons why they feel they need to keep rates high, and I think you want to dive into
so
that.
I think this is important because right now, again, we just pointed out, credit card debt's what really financing the consumer. But how much longer can the consumer basically, depend on credit card debt? I mean, there is an end in sight, right? And so just in time for that to probably happen, call it maybe mid-year, right? We start to see that peak. I want to go through the Fed's remarks today, and I'll make some comments and just kind of get your thoughts on this. But it really goes counter to what we're seeing, right? And you can kind of see where the inflection point or the moment happens. Well, the Fed came out today and they said inflation to 2% even if it takes a recession. Okay.
Which is something we have said for a long time. We will raise rates until something breaks, right? We said that all throughout last year, even at the end of 21.
And then another one that he said concerning that hikes have not lowered inflation, right? And I think this goes back to something we talked about last time, Chris, when you were on, is we keep relying, and then we think a lot of the economists, the Fed, chairman and the Federal Reserve, FOMC, are looking at old, backward dated looking models, right? And things have changed. And I think one of the biggest comments that he came out, he said they'd rather raise rates too high than keep low.
Yeah.
And for me, if you just want to isolate one thing that was said, that is the biggest change in narrative that we've seen in the past decade plus.
Yeah.
Right? It's been the Fed at your back. It's been accommodative. He's clearly telling you now they'd rather keep raising. So this is where, back to what you said, January thought there was going to be a pause and maybe a pivot, right? And then February, that kind of changed with the CPI number. And now the Fed is telling you they're going to go too far. And so what I think we pointed out with the consumer, I don't know if the consumer has enough gas in the credit card machine to keep going if the Fed pushes us further. And by the way, the other comment, he said they're open-minded about a 25 to 50 basis points hike in March, which I think, again, that's them pushing
and
further.
25 was priced in, 50 was not, and that's a lot of what we saw, in February in the market reaction, so to speak. But like we said, they're using backward-looking data to make forward-looking decisions. We're looking at things like the dispersion between savings rate and credit card. I know we focused on that a lot, but that's one of those leading indicators that shows you that not only are people putting more on credit cards, the cost of those cards is going up rapidly with the rise in rates. And that's why we think that the consumer could fade very quickly and really get us into a potentially disinflationary pattern. And at that point, the Fed's going to continue to use backward-looking data, and they'll likely over-tighten or hold rates too high for too long, but they will achieve their goal of probably getting inflation down. Now, there are a number of reasons why inflation may need to stay high, and I thought I'd like to flash one chart, and that would be we've talked a lot about the changing narrative, and I'll throw this up now, and it's the dispersion between typically we talked a little bit about PMI and that being a leading indicator. Well, typically if you put them on a graph together, PMI and the 10-year bond yield, U.S. 10-year Treasury bond yield, they move in sync with one another.
Yeah.
Start beginning in COVID, and then now after the peak of COVID. We have seen a rapid and wide dispersion, between the 10-year yield and PMI. PMI is in contractionary territory, but yields are still, very, very high. And so I think that really goes back to, again, that changing narrative, right? Where, the Fed, this just shows you where they would be accommodative, right? As PMI contracts, they drop, rates, and then they do quantitative easing, whatever it might be, and then they can just be accommodative. What this is telling us, what this dispersion is telling us, and what the Fed has dictated today in their commentary that moved markets quite a bit, is they're not going to be that stopgap, right? The Fed put, if you will, right? I remember we were talking about before the episode today. Remember the days of, the market's down 2%, pals on TV, right? That's not happening anymore, right? They could care less, and so that's what's happening.
Then they don't care. And so I actually got one chart here I want to kind of bring in because I think it really isolates what the Fed and what they're looking at. So if you look at this chart, it talks about household debt around the world. Now, I was rather surprised by this, but think about it this way. Remember, we've talked about this on the show many times. There's three ways to get out of debt. One, GDP, you grow. right? Well, okay, we can grow, but certainly to grow our way out of debt, probably very impossible. I think it's not going to happen. Default, which nobody wants to default. I mean, the D word is definitely one that I think the United States, being the world reserve currency, is probably the last thing you've got to worry about. I know many people think differently, but again, tell me what's
especially with the debt ceiling.
Exactly. And then tell me what the next best currency is. Good luck on that one. And then inflation. And if you look here, as a matter of fact, in the past 3 years, the total household debt to GDP in the United States has actually declined. And if you see here, I mean, we're not that bad when you compare yourself to all these other countries. Some of them are surprisingly here, right? So that's another reason why, well, shoot, you know what? You can inflate your way out of this debt. And that might be another reason why you see the Fed committed to pushing this further than what they normally do.
There's 3 ways to get out of debt. It's grow, default, or inflate your way out of debt. Or debase, same difference,
thing, right?
So, I mean, and that's there's a demographic reasons for that too. Why countries like a Switzerland or an Australia would have higher debt GDP ratios. But you make a very good point. That could ultimately be a peripheral goal, of the Federal Reserve. But we talked a lot about, them keeping rates high, specifically focusing on inflation, and then also why, basically we could enter into a disinflationary period very quickly. But there are still a number of reasons why, at least we think potentially that inflation may not ever get back to 2%, and there's in turn there's a lot of reasons why rates will stay high as well, or higher than what maybe some people anticipate even after they become more accommodative. And that goes back to what we were talking about at the end of last year, right? Demographics, deglobalization, and decarbonization, right? There are big macroeconomic changes going on in the world as a result of COVID that will create sticky inflation in certain areas. Energies will be more expensive. There's a lower supply of labor, which means sticky labor costs, higher wages, more inflation. Those are just, we talked about it more. Go back and watch that episode last time I was on, and we dove into it a lot deeper. But even if goods inflation, shelter inflation, and then the consumer fades, which are all disinflationary, effects, there's still going to be those sticky underlying long-term, pieces of the inflation puzzle that may cause them to keep rates higher for longer, despite a recession or what have you.
So absolutely. Well, so if anything is, again, and I think kind of now just kind of moving in, what are implications for our portfolio? I mean, how do you take all of this data? What should you do? I think the number one thing, obviously, if you're not doing this, then shame on you. You should be doing it. But in what we do for all of our clients is we're using the financial plan that incorporates your goals, your long-term plans, everything that you have coming in, coming out to make the investment decisions. So that is number one. You have to be doing that here. And I think, kind of just looking at increased volatility. I think that's here to stay. Inflation is going to be volatile. I think that's here to stay. And so, the implications for portfolios, a lot more volatility. So trying to be cute and try to time this stuff is going to be very difficult.
Yeah. And this brings in a great chart that, we've had in the office here for a few weeks. And that is, the chart that you see here, we'll flash it up. It shows, the volatility of the S&P 500, interest rates, and currencies. And you'll notice after the great financial crisis, things faded, and they faded quickly, right? We were in this long-term period of accommodative policy, low volatility, high returns, and what have you. And now you look at 2022, you've seen that flip on its head, right? You've seen not only interest rates get volatile, but the S&P 500, currency, everything in between, right? We're exiting this regime of stability, of low inflation, of stable growth to a period of a lot more volatility. And that's not just in your stock market piece of your portfolio, your equity portfolio, that's in your bond portfolio as well. And so we think that stocks and bonds will become increasingly correlated over the coming years. They will be increasingly volatile. That isn't to say that investors won't hit their return targets, right? You can still make, whatever your financial plan says you need. You're just going to do it in a lot choppier of a fashion. And that ultimately leads to more sequence of returns risk, right? Or the risk that I need to get money when I'm in one of those deep troughs, so to speak. And so, like you were saying, those expectations for higher volatility need to be reflected in the software tools you're using, to optimize your portfolio. It's what we do with our clients, here at Avidian.
Stress test.
And stress test and what have you, And so, again, a lot of people have asked me then, well, Chris, I don't want that portfolio. I don't want the traditional stock bond portfolio that's going to be far more volatile than it has been for the last decade. And that's why you and I harp so much on that third sleeve of diversification, right? And that's not just, private alternatives that are set aside for the most ultra wealthy investors. There are ways to get uncorrelated assets in your portfolio still, where they don't have suitability standards, but obviously the more wealth you have, the more suitable, more advanced investments are, more options you have. Exactly. But we've talked about alts on this, or alternatives on this program since we started it, so to speak. And this is precisely why, is you need a third sleeve of diversification to smooth returns and maximize your risk-adjusted returns.
Well, I like what you're calling a third sleeve. And actually, there was a survey put out by, family offices. So if you don't know what a family office is, they manage, a high net worth family. So think of the affluent, right? And the survey showed that, an increasing number of assets diverted towards alternatives. As a matter of fact, they think they're probably going to see, wealthy families, wealthy individuals land somewhere about 30% in alternatives or non-correlated assets. It's going to consistently move in that direction.
Yeah, exactly. And that's, and again, it's not just the hedge fund strategies reserved for the ultra wealthy. There are ways to get access to these things. We try to make them available for our clients here at Avidian, but ultimately that's what we feel is most important, right? Is you're going to need you're going to find a way to create a smoother return profile, especially if you're in your retirement in this traditional volatile environment, and I think that's how we're going to do it. But I wrote something down here in front of me, and it's ultimately, a lot of people say, okay, well, we're resetting, right? We're at the end of a business cycle. We're going to start a new ball game. And I would argue we're playing a different sport now.
That's a great analogy. I think it's a great way to look at it. As a matter of fact, I probably think that's a great way to end the show because, if there's anything that summarizes it, and I guess the question is for you is, are you prepared for that new sport? And if you're not, we'll definitely get a hold of us. You know where to contact us. You got our emails, got our phone number. And thank you for listening to The Lowdown.